Paying tax in India and the UK on the same income? Well, stick around for this explainer, because you might actually be overpaying your taxes without even realizing it. We are looking at a massive blind spot today for anyone managing cross-border wealth, specifically between India and the United Kingdom. So here's the million-dollar question. Are you paying tax in both India and the UK on the exact same income? Because if you are, you could be seriously overpaying if you're not using the India-UK Double Taxation Avoidance Agreement, or DTAA, correctly. Look, so many Indians living in the UK earn income back home in India. It's super common, right? But here's the trap. India might tax that income at the source. And then, thanks to the UK's worldwide taxation rules, the UK wants to tax it too. We call this the double taxation trap. It's basically a structural conflict that can literally eat away your investment yields if you're not careful.
All right, so here's our roadmap for this explainer. We're going to quickly walk through the double taxation trap, source versus residence taxation, the DTAA shield, some simple tax credit math, and finally, how to actually claim your relief.
Starting off with Section 1, the double taxation trap.
So, what kind of income gets caught in this cross-border net? Well, if you're a UK resident, the most common triggers are things like rental income from a property in India, interest on your NRO fixed deposits, dividends from Indian companies, and capital gains from selling real estate or stocks. Every single rupee you generate from these sources gets hit with a pretty aggressive tax structure right out of the gate.
Which brings us to the big, scary question. Do you actually pay tax twice? See, under domestic Indian law, India says, hey, this money was made here, we're taxing it. But at the same time, the UK says, hey, you live here, we're taxing your worldwide income. So without some kind of coordinated relief, yeah, you'd be taxed by both treasuries on the exact same money. No way we want that.
To understand exactly why this happens, let's look at Section 2, Source versus Residence Taxation.
This right here is the core conflict. It's like two different rule books. India uses source-based taxation, meaning they aggressively tax money exactly where it's generated. The UK, on the other hand, uses residence-based taxation, meaning they tax you based on where you live, no matter where your money is sitting. And wow, this is a massive issue right now. Why? Because the UK officially abolished the old non-domicile tax regime in April 2025. That protective remittance basis is gone for most folks. So if you've lived in the UK for a while, you're now taxed on a global arising basis, meaning HMRC wants their cut the second you earn a rupee in India, even if you never bring that money into the UK.
And man, here's where it really hurts, 31.2%. That is the domestic tax deducted at source, or TDS rate, applied under Section 195 in India. Let's say you're a non-resident Indian landlord. Your tenant is literally legally required to deduct a flat 31.2% on your gross rent. Got an NRO fixed deposit? The bank is taking around 31% before you even see a single rupee of interest. Add that to UK marginal tax rates, which can hit 45%, and you can easily see how devastating this trap really is. But don't panic just yet. Let's move to Section 3, the DTAA shield. The India-UK Double Taxation Avoidance Agreement is basically a bilateral contract that overrides local tax laws just to stop you from being taxed twice. It was signed way back in 1993, updated in 2013, and modified in 2020 to prevent abuse. This treaty is your absolute best defense, and like I mentioned, with the UK non-dom regime gone as of April 2025, wrapping your head around this treaty has literally never been more crucial for protecting your wealth.
Now, the main tool this treaty uses to save your hard-earned cash is called the Foreign Tax Credit, or FTC. It's governed by Section 90 in India and TIOPA 2010 in the UK. But in plain English, it's simply a relief system. Your country of residence, so the UK, reduces your final tax bill by the amount of tax you already paid to India. You basically get credit for the taxes they already withheld at the source.
And it gets better. The treaty strictly caps the maximum percentage India is legally allowed to withhold from you as long as you prove your UK residency. Check this out. General dividends, capped at 10%. Interest is capped at 15%, or just 10% if it's paid to a bank. Royalties and fees for technical services are capped between 10 and 15%. I mean, that is a huge drop from that standard 31.2% domestic rate we talked about earlier.
All right, so how does this actually play out in real life? Let's jump in to Section 4, the tax credit math.
HMRC is super strict about how this works, laying it all out in Help Sheet HS 263. You have to use what's called the lower of restriction. Step 1. Calculate the UK tax on your Indian income. Step 2, identify the Indian tax you actually paid within those treaty limits. Step 3, your credit is restricted to the lower of those two numbers. You can never claim more credit than the actual UK tax liability for that specific income. And finally, Step 4, you just pay the difference to HMRC.
Let's make it concrete. Imagine Priya has a rental property in Bangalore. She earns 10 lakhs in rental income. After all her deductions, let's say her UK tax liability on that rent is calculated at 3 lakhs. But wait, she already filed in India and paid 2 lakhs in Indian taxes. Because of the foreign tax credit, Priya takes the lower of those two numbers, which is the 2 lakhs she already gave India, and uses it as a credit in the UK. So instead of paying 3 lakhs plus 2 lakhs, she subtracts her credit and only pays the remaining 1 lakh to HMRC. Her total global tax is capped at 3 lakhs. Boom. That's the DTAA working perfectly.
But you've got to watch out for this, the over-withholding trap. If you don't submit the right paperwork, your Indian bank might just go ahead and deduct 31.2% on your interest. But remember, the treaty cap for interest is only 15%. So when you go to the UK to claim your credit, HMRC is only going to credit you up to that 15%, legally permitted by the treaty. You totally lose the rest. That excess tax paid in India cannot be used as a credit in the UK.
Which brings us to the most actionable part of this whole explainer, Section 5, claiming your tax relief.
Here's the absolute most important thing you need to hear today. The tax credit is not automatic, right? HMRC is not going to just magically apply this to your account, and Indian banks definitely won't automatically lower your TDS. You have to proactively report the income, do the currency conversions correctly, and explicitly claim the relief on your tax returns.
So let's build your defense file. To get those lower DTAA rates in India, you must provide the payer with a UK tax residency certificate, which you get from HMRC, along with an electronic Form 10F on the Indian tax portal and a valid PAN card. Then, when you want to claim the credit back in the UK, you'll need your Indian Form 26AS and your TDS certificates just to prove the tax was actually paid. Plus, you have to explicitly claim the credit on the SA 106 foreign pages of your UK self-assessment. If you're missing these documents, your FTC claim will simply be denied.
Ultimately, managing your cross-border wealth really comes down to this one simple truth. The biggest risk isn't double taxation, it's forgetting to claim the credit you're entitled to. The laws are absolutely there to protect you, but they require strict compliance. You have to be proactive.
India-UK DTAA. Know it before you overpay tax. Seriously, if you're living in the UK and earning in India, please don't leave your wealth on the table. Make sure you've got your tax residency certificate, get those forms filed right, and for sure, chat with a cross-border tax professional. Because at the end of the day, you have to ask yourself, how much of your own hard-earned money are you accidentally tipping to the taxman right now?